Everything you've been told about debt is incomplete. You've been taught that debt is always bad. Pay it off as fast as possible. Stay out of debt. Debt is slavery. Debt is risk. Avoid it at all costs. This advice is correct in a stable economy, but it's dangerously incomplete when inflation accelerates. During inflationary periods, something extraordinary happens. Some debt actually protects you. Some debt becomes your greatest asset. Other debt destroys you completely. A person with the right debt thrives when inflation accelerates. A person with the wrong debt is obliterated. The difference has nothing to do with the amount borrowed. It has everything to do with the structure of that debt. A fixed-rate mortgage becomes more manageable as inflation erodes its real value. A variable-rate mortgage becomes catastrophic as payments adjust upward. A dollar-denominated loan becomes unserviceable as the home currency collapses. A home currency loan at fixed rates becomes advantageous as currency depreciates. The same person with $2,000 of debt could be completely protected or completely destroyed depending entirely on the structure of that debt. To understand which debts save you and which destroy you, you need to understand what actually happens to debt during inflation. Most people get this completely wrong. When inflation accelerates, debtors suddenly have an advantage. They're paying back loans with currency that's worth less than when they borrowed it. Most people don't understand this. Debt is fundamentally a contract denominated in currency. You borrow $100,000 at 5% fixed rate. You promise to repay that money over 30 years at 5% interest. The contract is written in dollars. When currency depreciates, something crucial happens to that contract. The debt burden decreases in real terms. You borrowed $100,000 when that currency had a certain purchasing power. You're repaying that debt with currency that has less purchasing power. You're paying back with depreciated money. If inflation is 10% annually and your interest rate is 5% fixed, you're effectively borrowing at a negative real interest rate. The lender is losing. The borrower is winning. This is mathematical, not theoretical. This mechanism works if debt is fixed rate and denominated in a depreciating currency. A 30-year mortgage at 4% fixed while inflation runs 8% creates a mathematical advantage for the borrower. The mechanism doesn't work if debt is adjustable rate. If your rate adjusts upward with inflation, the advantage disappears. The mechanism doesn't work if debt is indexed to inflation. Some government bonds include inflation adjustment clauses that protect the lender. The mechanism doesn't work if debt is denominated in stable foreign currency. If you borrowed in dollars and your home currency depreciates, you're destroyed, not protected. Historical evidence proves this mechanism repeatedly. Japan maintained zero or near zero interest rates for 30 years while inflation ran modestly. Debtors benefited enormously. The government, as debtor, could service massive debt because inflation eroded it. Bondholders were destroyed through negative real returns. The United States after World War II had massive government debt. Economists predicted bankruptcy. Instead, inflation eroded that debt systematically while government revenues grew. The debt that was supposed to bankrupt America became manageable. Argentina in 2001 showed this mechanically. Debtors with peso-denominated debt benefited when the peso devalued 70%. They paid back debt with worthless currency. Savers with peso savings were destroyed. Venezuela demonstrated the same mechanism as currency collapsed. Fixed-rate debtors benefited while currency depreciated. The crucial distinction is architectural. Fixed-rate debt denominated in depreciating currency equals debtor advantage. Variable-rate debt or foreign currency debt equals debtor disadvantage. Short-term debt requires refinancing at higher rates, creating disadvantage. Long-term debt locked in at old rates creates advantage. So, if debt can be advantageous during inflation, which specific types of debt actually protect you? And which types destroy you? These 5 types of debt become your protection when the currency collapses. The people who held them thrived. The people without them were destroyed. The first type is a fixed-rate mortgage taken at a long-term horizon in your home country currency. You borrow at 4% fixed. Inflation accelerates to 8 or 10% annually. Your monthly mortgage payment stays the same in nominal terms. But something crucial happens. That payment becomes a smaller percentage of your income because your income is inflating. In real terms, your debt burden is declining every single month. The United States government understood this after World War II. It had taken on massive debt to finance the war. Instead of paying it down immediately, the government allowed inflation to erode it systematically. Inflation ran at 4 to 5% annually for decades. The government's fixed debt obligations remained the same while the economy inflated around them. The debt became manageable, then easy to service. Savers who held government bonds were destroyed. Borrowers who had mortgages benefited enormously. Argentina provides a more extreme example. Debtors with peso-denominated mortgages faced a choice. When the peso devalued 70% against the dollar in 2001, their monthly payments stayed the same in pesos. But the peso was now worth so little that the payment had become trivial in real terms. Debtors could service debt far more easily. Savers with peso savings were obliterated. The second type is a fixed-rate business loan that finances a productive asset. You borrow money at a fixed rate to finance your business or real estate investment. Your business revenue increases with inflation because you can raise prices. Your monthly loan payment stays the same in nominal terms, but the loan payment becomes a smaller portion of your growing revenue. Your business becomes more profitable in nominal terms even if operational efficiency stays constant. Successful entrepreneurs in inflationary environments use this mechanism. They borrow to expand, revenue grows faster than debt, and debt is paid down with depreciated currency. The third type is government bonds issued at fixed rates in home currency. The government issues a bond paying 3%. Inflation accelerates to 8%. The bondholder receives 3% while the currency is depreciating at 8%. The government, as debtor, benefits enormously because it's paying back with worthless currency. This is financial repression. Japan demonstrated this for 30 years. The government maintained zero or near zero interest rates while inflation ran modestly. Bondholders were systematically taxed through negative real returns. The government, as debtor, benefited from inflation eroding its obligations. The fourth type is consumer credit at fixed rates below inflation. A personal loan at 5% fixed while inflation runs 8%. Your payment stays the same while your income inflates. Your debt burden declines. The fifth type is student loans at fixed rates with income-based repayment in home currency. Your income increases with inflation and career progression. Your monthly payment stays the same or increases modestly. Your real debt burden declines over time. If forgiveness programs exist, inflation reduces real debt value before forgiveness eliminates remaining balance. What these five have in common is decisive. All are fixed rate. All are denominated in home currency. All are long-term without refinancing requirements. All benefit when currency depreciates. All put the debtor in an advantageous position during inflation. These five debts can actually protect you during inflation. But there are three types of debt that destroy you. These three can bankrupt you when currency collapses. These three debts will destroy you when inflation accelerates. People who held them lost everything, and they had no choice, they were trapped. The first type is variable rate debt with adjustable interest rates. You borrow at prime plus 2%. The interest rate is not fixed. It adjusts upward as inflation rises and central banks raise rates to combat inflation. Your monthly payment increases as rates rise, but your income doesn't increase proportionally. Your payment becomes larger while your purchasing power is declining. The debt becomes unserviceable. The United States housing crisis in 2008 demonstrated this catastrophically. Adjustable rate mortgages were marketed as affordable. Rates were low initially, making monthly payments manageable. But rates were designed to reset upward after initial periods. When rates reset, monthly payments doubled or tripled. Homeowners who could afford $300 monthly suddenly couldn't afford $600 monthly. They couldn't refinance because property values had declined. They couldn't sell because nobody was buying. 10 million Americans lost their homes to foreclosure between 2007 and 2014. The mechanism was simple. Payment adjusted upward while income didn't. Argentina in 2001 experienced the same mechanism. Variable rate mortgage became unaffordable as rates adjusted. People couldn't make payments. Properties were seized. The second type is foreign currency debt. You borrow in dollars. Your income is earned in home currency. Your home currency depreciates against the dollar. Your monthly payment in dollars stays the same. But that payment now requires exponentially more home currency. Payment becomes unaffordable quickly. Argentina between 1998 and 2001 provides the clearest example. Many Argentines borrowed in dollars because the peso was pegged to the dollar and seemed stable. When the peso devalued 70% against the dollar, debt payments effectively tripled in peso terms. People couldn't service debt. Defaults cascaded through the entire economy. Venezuela between 2014 and 2019 experienced similar devastation. Venezuelan companies borrowed in dollars. The bolivar collapsed against the dollar. Debt service became impossible. Companies defaulted or ceased operations. Lebanon starting in 2019 suffered ongoing catastrophe. Lebanese individuals and businesses borrowed in dollars. The Lebanese pound collapsed against the dollar. Debt service became impossible. The banking system froze. Mechanism is absolute. Fixed dollar payment plus depreciating home currency equals unserviceable debt. The third type is consumer debt at high interest rates. Credit cards at 25%. Payday loans at 400% annual rates. Interest rates adjust upward or stay very high during inflation. Monthly payments increase or stay very high. Income doesn't increase fast enough. Debt becomes perpetual because interest exceeds principal payment. During inflationary periods, a consumer paying 25% on credit card debt watches inflation erode income while the interest rate stays constant or adjusts higher. Payment becomes a larger percentage of income. Debt becomes unmanageable. Payday loans are catastrophic. Borrowed at 400% annual rates, the payment becomes unaffordable within weeks. Refinancing perpetuates debt rather than resolving it. Consumer becomes trapped in debt spiral. Venezuela during hyperinflation showed the ultimate outcome. High-interest consumer debt became unpayable overnight. People defaulted en masse. Credit disappeared. What these three have in common is decisive. All are variable rate or high rate. All adjust upward during inflation. All are denominated in foreign currency or carry unaffordable rates. All put debtor in catastrophic position during inflation. All lead to default when inflation accelerates. All destroy the debtor's financial position. The difference between the 5 debts that save you and the 3 that destroy you comes down to one thing. Whether the debt adjusts during inflation or stays fixed, the people who understood this distinction thrived during inflation. The people who didn't understand it were destroyed. The mechanism is simple. The outcomes are absolute. Fixed-rate debt during inflation operates through a straightforward mechanism. Your monthly payment stays the same in nominal terms. You borrowed at 4% fixed. The bank can't change that. Your payment remains identical month after month, but your income increases with inflation. Prices rise, salaries rise, business revenue rises. Your payment, which was perhaps 30% of your income when you took the loan, becomes 20% of your income, then 15%, then 10%. In real terms, your debt burden is declining systematically. You're effectively paying back the loan with currency that's worth less than when you borrowed it. The debtor benefits from inflation eroding debt. A mortgage taken at 4% with 8% inflation means you're borrowing at a negative real interest rate. The bank is losing money. You're gaining value. Historical example, a mortgage taken at 4% when inflation is 8%. Your payment stays the same. The purchasing power of that payment declines. Your real debt burden declines every single month for 30 years. The debtor is systematically enriched by inflation, variable rate or high rate. Debt during inflation operates through a catastrophic mechanism. Your monthly payment adjusts upward with inflation and rising rates. Your income may not increase proportionally. Your payment becomes a larger percentage of income. Your real debt burden increases. You're destroyed by inflation increasing payment. A credit card at 25% with 8% inflation means the interest rate stays high or adjusts higher. Your payment increases or becomes unaffordable. The debtor is systematically destroyed by inflation. Foreign currency debt during inflation operates through economic collapse. Your payment in foreign currency stays the same. Your home currency depreciates. That dollar payment now requires exponentially more home currency. It becomes unserviceable. An example, dollar-denominated debt during peso collapse. Your payment in dollars stays the same. But peso depreciation means that payment now requires 3 times as much pesos as it did before. It becomes unaffordable. Debtors default en masse. The critical distinction is architectural. Protection comes from debt being denominated in depreciating currency with fixed rates. Destruction comes from debt being foreign currency denominated or adjusting upward. Timing matters decisively. Long-term debt is protected. Short-term debt must refinance at higher rates. Amount matters far less than structure. Understanding this distinction changes how you should think about your debt portfolio. But there's a deeper question. Should you strategically take on debt if inflation is coming? This is where most people get it wrong. They think avoiding debt is always safer. But strategic debt during inflationary periods can be the most important financial decision they make. Strategic borrowing makes sense under specific conditions. You must be able to borrow at a fixed rate below expected inflation. If you borrow at 4% fixed and inflation is 8%, you're borrowing at a negative real interest rate. The lender is losing. You're winning. You must be borrowing to finance a productive asset, not consumption. Borrowing to buy real estate that generates rental income is productive. Borrowing to buy a car that depreciates is consumption. You must have stable income to service debt. If your income is uncertain, debt is a weapon against you. You must keep debt in home currency. Foreign currency debt is catastrophic. You must have long enough debt term to benefit from inflation. A 1-year loan doesn't benefit from 30-year inflation. You must fully understand the risk. Most people don't. The example of strategic borrowing, borrow to buy real estate at 4% fixed. Rent increases with inflation. Your monthly mortgage payment stays the same. Rental income inflates, but debt payment doesn't. Real estate becomes more valuable. Debt becomes less burdensome. The borrower benefits from inflation. Historical precedent confirms this. Successful real estate investors during inflationary periods used strategic borrowing. They borrowed at fixed rates to finance properties. Inflation eroded debt while asset values and rents appreciated. They thrived. Strategic borrowing destroys you if you borrow at variable rates. Foreign currency, high interest rates, or for consumption. It destroys you if you lack stable income or fully understand mechanism. It destroys you if you're borrowing because you believe you understand timing. You don't. Strategic borrowing only works if inflation actually occurs. If inflation doesn't occur, you're simply paying interest for no benefit. This is gambling on inflation. Some people position this way because they understand the pattern. Most people shouldn't attempt this because they don't understand it. The key insight is decisive. The people who thrive during inflation often use debt strategically. The people who are destroyed often had debt forced upon them or didn't understand structure. Strategic debt is a tool for people who understand the mechanism. Ignorant debt is a weapon against people who don't. So, what does this mean for your current situation? If inflation is accelerating, what should you do about the debt you already have? Look at your debt right now. Understanding which of it protects you and which of it destroys you could mean the difference between thriving and being destroyed. The debt audit framework is straightforward. For each debt you hold, ask specific questions. Is the interest rate fixed or variable? Fixed rate debt can protect you. Variable rate debt will destroy you. Is the debt denominated in home currency or foreign currency? Home currency debt can benefit you during inflation. Foreign currency debt will destroy you. What is the interest rate? Below expected inflation is protective. Above expected inflation is destructive. What is the time horizon? Long-term debt is protective. Short-term debt must refinance at higher rates. Could you service this debt if your income declined 30%? If not, it's destructive. Could you service this debt if inflation doubled? If not, it's destructive. Fixed-rate home currency debt equals keep. A mortgage at 4% with inflation at 8% is becoming less burdensome over time. A long-term business loan at 5% with inflation accelerating is protecting you. These debts are actually protecting you during inflation. Variable rate, foreign currency, or high-rate debt equals prioritize paying down. Credit cards at 20% or higher. Variable rate mortgages, dollar-denominated debt if you earn in local currency. These become more burdensome. These will destroy you if inflation accelerates. Strategic opportunity exists if you have fixed-rate capacity and income stability. Borrow at fixed rate below expected inflation. Use proceeds to finance productive asset. Let inflation erode debt while asset appreciates. This is what sophisticated investors do. The reality check is honest. Most people can't do strategic borrowing. Most people should focus on eliminating destructive debt. Most people should understand their current debt before taking on more. Understanding your debt is the first step. But there's a larger context here. The people who understood debt structure during past inflationary periods didn't just survive, they actually benefited during every inflationary period. The people who thrived weren't the ones without debt. They were the ones who understood debt structure and used it strategically. The United States after World War II demonstrates this conclusively. The government had taken on massive debt to finance the war. Economists predicted this debt would bankrupt America. The government would have to default or suffer economic collapse. Instead, something different happened. Inflation eroded that debt systematically. Government revenues grew with inflation and economic expansion. The fixed debt obligations remained the same. Over 3 decades, the debt that was supposed to bankrupt America became manageable, then negligible. Savers who held government bonds during this period were destroyed. They received fixed interest while inflation eroded purchasing power. Strategic borrowers who financed real estate or business thrived. They borrowed at fixed rates, revenue inflated around them, and debt became less burdensome. The government benefited enormously from inflation. The debt-free saver lost wealth. Brazil, between the 1980s and 1990s, experienced high inflation. People who borrowed at fixed rates benefited. People who saved in cash were destroyed. Those who borrowed strategically to buy real assets thrived. Those who understood debt structure positioned accordingly. Those who didn't understand were obliterated. Argentina before 2001 showed the same pattern. Peso-denominated debtors benefited when the peso collapsed. They paid back debt with worthless currency. Real estate investors who financed with peso debt thrived. Savers who held pesos were destroyed. The advantage went to those who understood debt structure. Venezuela after 2014 repeated the pattern. Those with early debt taken at old rates benefited. Those who took on new debt at adjusting rates were destroyed. Those who understood currency dynamics positioned strategically. Those who didn't understand were obliterated. The pattern across all inflationary periods is consistent. Strategic debtors thrived. Cautious savers were destroyed. Those who understood structure had options. Those who didn't understand had no options. The advantage went to those positioned correctly, not to the risk-averse. The evidence is clear. In every inflationary period, the people who thrived were often those with the right debt. The question is, will you understand the difference before inflation accelerates? Everything you've been told about debt is incomplete. Some debt will destroy you. Some debt will save you. The mechanism determines which. Debt is not monolithic. Structure determines outcome. Fixed-rate debt in home currency can be protective. Variable rate, foreign currency, or high-rate debt is destructive. Strategic positioning using debt can provide significant advantage. Understanding the mechanism is crucial. Most people don't understand this. The people who do understand it will position strategically. The people who don't will be destroyed. The essential framework is simple. Is your debt fixed rate or variable? Is it in home currency or foreign currency? Can you service it if inflation doubles? Is it financing a productive asset or consumption? Could you service it if your income declined? The pattern is clear from history. The people who understood debt structure thrived during inflationary periods. The people who didn't understand were destroyed. The mechanism is mathematical, not ideological. Your debt will either protect you or destroy you when inflation accelerates. The difference has everything to do with the structure and nothing to do with the amount. Understanding this distinction, before inflation becomes obvious, is the difference between thriving and being destroyed.